Good afternoon. On behalf of the Pepperdine School of Law, I'd like to welcome you to Panel 4, which I will moderate. We have three highly esteemed authors and professors with us here today, and we also have Robert Goulder, who will be providing commentary on the papers. Starting
also highly esteemed.
with Ruben Avellana. We'll take comments from the panelists once they've been called. Starting with Ruben Avellana. He is the Irwin I. Cohen Professor of Law and Director of International Tax LLM Program at the University of Michigan Law School, where he specializes in corporate and international taxation. He's also the casebook author of the text that I use in my international tax class, and it's a great honor to have him here today. He has served as a consultant to the U.S. Treasury Department and the OECD, and is a member of the steering group for the OECD's International Network for Tax Research. He is also the chair of the AALS Tax Section and trustee of the American Tax Policy Institute, a fellow of the American Bar Foundation, and an international research fellow at Oxford University's Center for Business Taxation. Professor Avellana has taught at my alma mater, Harvard University, and Boston College. He also practiced with Milbeck Tweed in New York and with Wachtell Lipton in New York, and finally with Ropes and Gray. Will you please help me welcome Professor Avellana to our panel? Next, we have Allison Christians. Allison Christians is the H. Hewart Steichman Chair in the Law of Taxation at McGill University. Her research and teaching focuses, among other areas, on national and international tax law and policy issues, with an emphasis on the relationship between taxation and economic development. Professor Christians practiced tax law at Wachtell Lipton as well in New York, where she focused on the taxation of domestic and cross-border mergers and acquisitions. She also practiced at Debevoise and Plimpton in New York, where she focused on private equity funds. Again, will you welcome Professor Christians? Last but certainly not least, we have Susan Morse, who is an associate professor of law at UC Hastings College of Law. Professor Morse studies and writes about international tax policy and tax compliance. Her current research interests include offshore account compliance and transition issues related to international business income tax reform. Professor Morse clerked for the First Circuit, United States Court of Appeals. She also spent 7 years in tax practice at Ropes and Gray in Boston and Wilson Sonsini in Palo Alto. Prior to joining the Hastings faculty in 2010, Professor Morse was at Santa Clara University School of Law. Again, would you please welcome our final panelist, Professor Morse. Each panelist will have approximately 15 minutes to present his or her papers. I would now like to invite Professor Christians to the podium to start her presentation. Oh, excuse me. Actually, we're going to start with Professor Avellana. Thank you.
Either way, thank you very much, Professor Johnson, and thank you, Paul Caron in particular, for inviting me, and the Pepperdine Law School and the Pepperdine Law Review for this wonderful hospitality. This, I have to say, I think most of us will agree, is the best organized conference I've ever been in, and I've been to lots of conferences. Genuinely, amazingly well done, as well as, the weather, the surroundings, and so on. It's all perfect. So, as you have seen, if you look at the paper, I addressed lots of topics, and I'm only going to concentrate on one of them. I will say one thing about VAT, since this was already a subject of Professor Gratz's discussion in the morning, and Bruce Bartlett and others. In the last election, as you may remember, Mitt Romney and Paul Ryan promised not to touch Medicare for anybody who's reached the age of 55. Since I was 54 at the time, I was really upset by that, because I thought I would be the last sucker left standing who will be the oldest person whose Medicare will be cut. But now the election is over, and by 2016, the very last baby boomer would have turned 55. So I think Medicare is pretty much safe. And as a result, I think our budget deficit whole, which is scheduled to reach, the debt is scheduled to reach something like over 200% of GDP by the early 2030s, cannot realistically be fixed without raising taxes. So I join Professor Gratz and Professor McCaffrey and others in advocating a federal level consumption tax. Having said that, let me move on to international, which is what I mostly want to talk about. And as you've already heard from Martin Sullivan, the hot topic in Washington now is this whole debate about territoriality and exemption and deferral and so on, as usual. And the CBO has just put out a study dated January 2013, so it's quite recent, in which they estimate various options. And one thing that's interesting is that they have kind of the two extremes. They have complete abolition of deferral on one hand, and then they have pure territoriality with no anti-profit shifting or other devices and no interest allocation and none of the nice stuff that Marty was talking about. And it turns out that they both raise revenue magically. Abolishing deferral raises $114 billion over the 10-year window, and exemption raises $76 billion, and then you can have another $60 billion from touching interest deductions. So that, I think, is very interesting by itself, because it just suggests how broken our current system is, basically, that we managed to lose it both ways. Now, I've written a paper that was published in Tax Notes back in May, suggesting that the gap between the two proposals that are actually on the table, that is the President's proposal and the Camp proposal that was already mentioned, is not as huge as might seem at first glance. Because if you think about it for a moment, what Obama was proposing was a minimum tax that is abolishing deferral, but setting the rate at the rate that is lower than the normal corporate tax rate, which he suggests should be 28. But he doesn't say what the rate is, nor does he address what happens to dividends after that tax has been paid. And as was suggested already in the last panel, there has been some hinting that the Democrats might be willing to live with some measure of territoriality. So let's assume, for example, that you set the minimum tax rate at 25. So at that point, of course, the difference is only 3%, and you might as well accept to bring the money back without paying anything more. But now let's take a look at the Camp proposal. Camp wants to set the rate at 25. And one of the things that he does is that he has these anti-profit shifting proposals, and one of them is to tax subject to subpart F, that is tax currently all income that is subject to an effective tax rate of 10% or less in the host jurisdiction. So think about it for a moment. This means that all income that is not subject to 10% will be subject to tax at 25. And the only difference, as far as I can see, between Obama and Camp that remains is maybe a country like Ireland when it's 12.5, and I imagine the 10% was set in order to exempt Ireland. But remember, this is an effective rate. So if you have a double Irish Dutch sandwich, as was described, and the effective rate is 2.4 because it's all really in Bermuda, then that actually will be captured by Camp. And so I think that as a practical matter, there's some room for compromise between these two proposals, and I'm not sure that it really is so extreme as might happen, which might suggest to us that something might actually be done about this in the near future, although who knows. But in any case, I hope it will, because the current situation is not very palatable, where, as was also described in the last panel, there's a lot of money sitting offshore tax-free. Now, let me say one thing about that, because I think it's useful to say, and this relates to another thing that Professor Gratz said in the morning, which is that there's no pot of gold in this particular tax reform effort. Well, I actually think maybe there is. I mean, I'm not sure how big it is exactly, but there's a potential pot of gold. The pot of gold is the $1.7 trillion that are sitting offshore at the moment. Because the economists will tell us, I mean, this is a little bit like the whole business about why is the efficiency gain from the move from an income tax to a consumption tax, because there's a one-time tax on all savings. So here also you can impose a one-time tax on all of this $1.7 trillion that are sitting offshore, and you won't affect anybody's behavior because by definition they're there already. Plus, it is my view, and most people think, that most of this income belongs to the United States anyway because it relates to intangibles that were developed here and were shifted offshore in the ways that were described earlier. So why not tax them? So then it's just a question of what rate exactly you want to impose, but certainly there is some pot of gold to be had in this context. Now, having said that, I think that what the reply probably would be is that if you do that and then you also tighten the CFC rules, like both Kemp and Obama propose, then there would be a risk that corporations will leave the United States, because the whole system now depends crucially on the residence of the parent. The residence of the parent is a matter of where the parent is incorporated, and one thing that is happening now, again, is a rise in so-called inversion transactions in which companies actually move out of the United States. They do it by using loopholes in the 78-74 rules that were adopted back in 2004 to stop precisely this behavior. So I think this needs to be addressed, and I've already said back in 2004 that the way they did back then was not very good. And I think what we should be doing is, at the very least, adopt some kind of measure and control standard, which is what the Europeans and the rest of the world have, so that at least you'll have to, if you're going to be a decentered multinational in the mere DSI standard, you need to actually move your headquarters out of the United States, which in my experience is not so easy to do. That doesn't mean that it will block all moves, but it will block some moves, and it also means that you can't do shell corporations. That is, you need to have something real out there rather than a post office address in the Cayman Islands. So I think that would be a good step to take in conjunction with any of these moves to try to tax more offshore income currently. Having said that, I don't think this is a stable solution in the long run. And the reason that I don't think it's a stable solution in the long run, or even in the medium run, is simply because in the end, I don't think there's enough of a distinction, or enough of a meaningful distinction, between US headquartered and foreign headquartered firms to really base our entire international system on this particular line. Inversions is just part of the story. It's also a question of where you set up the corporation to begin with. So if you start offshore, you can start offshore and you never have to be in the United States. And as was said earlier, I mean, the multinationals is decentered. So yeah, I mean, maybe there's a meaningful distinction between GM and Toyota and Volkswagen, but I'm not sure that I really buy it, at least not as we go on in the 21st century. So that brings me back to, what my original proposal was 20 years ago, which is to have formulary apportionment, as was already mentioned also. And this, interestingly, is another of the options that is mentioned without a precise revenue estimate in the CBO report, so at least it's on the table. And the reason, of course, that I think that is good is primarily because, A, it ignores the difference between foreign-based and US-based multinationals, because they all are treated the same. Whatever the formula allocates to the US, that's what you take. B, it achieves true territoriality, not this kind of, I regard what's now on the table in Washington as bogus territoriality, because all we're talking about really is not, as is sometimes said, exempting foreign source income from tax. It's not true, because you're going to keep Subpart F, and you're going to keep the foreign tax credit, and you're going to keep all of this complexity. All that you're doing is exempting dividends from active income from tax, which is not really such a big deal, after all. And it's not even a significant revenue raiser, I don't think, because at the moment the dividends simply aren't coming in. It does have a behavioral effect, because that's the whole trapped income phenomenon, and that's why I think it should be done, but it's not a really fundamental change. What you do if you have formulary is, in my opinion, you can have true territoriality, and whatever the formula allocates to the US, that's what you tax, and then you forget about CFC rules, and you forget about foreign tax rate, and you forget about everything. And you ignore all dividends within the multinationals, and you ignore all royalties within the multinationals, you ignore all interest, you treat the multinational as what it really is, which is a single enterprise that is consolidated together, and you then slice it up according to the formula. Now, there are, of course, lots of problems with this, including how to pick the formula. The EU Commission has proposed a formula that is based on more or less the state formula, that is assets, payrolls, and sales, in equal proportions and with some modification and so on. That's one possibility. I don't particularly like it, because I think that this will induce the shift of jobs out of the United States. So I had always liked what is now called, Ellen Auerbach, destination-based income taxation. I didn't think about that name in 1993, but that's basically, it's a sales-based formula. The idea is you tax multinationals initially based on where they sell it, and that's it. And of course, the advantage of that is that you tax importers and you exempt exporters. It has all the VAT type advantages. It has problems too. such as, I mean, for goods, it's not a big problem because we have borders unlike the EU and we can trace the goods as they're coming in. For services, it's more complicated, but the VAT does deal with that, so I think it is a soluble problem. And I think it's a big revenue raiser, a very big revenue raiser potentially, although they didn't put a number on it. And it does away with all of this game playing, fundamentally, and I think it's also a simplification measure. So this is what I would think we should work on. Now, there are other issues with it. So, for example, what about treaties? So the treaties all say, Article 9, you have to do the arm's length standard, and now the OECD has nicely applied this to Article 7 too, so even if you have a branch, the same thing applies. But I actually think there's a way of doing this, and this is what Mike Durst and Tim Flausing and I proposed with legislative language even in the Florida Tax Review back in 2009. And that is to use comparables to the extent that comparables can be used. That is, there are all kinds of routine stuff that can be used by using comparables. But then the big problem with national is that you get a big residual, and that's where most of the money is. The residual comes from intangibles, or it comes from internalization of costs, or whatever it comes in, doesn't matter. But this big residual cannot be allocated by using comparables because by definition you can't find it. I mean, you allocate by comparables whatever you can, and that's what's left over. And so then you allocate that by formula, and in my opinion, this is simply, we will say that this is consistent with the arm's length standard. Why? Because the arm's length standard says that you're supposed to set the prices based on what unrelated parties would hypothetically have set them. Once you don't have comparables, nobody can prove that this is not what people would have set at arm's length because comparables don't exist. So therefore, whatever formula you choose, that's the right formula, and that's it. And I think that this can be done, in fact, in my opinion, unilaterally, and the rest of the world will go along, because if they don't, since we only tax based on sales, every single other multinational will put their entire income in the United States, which is not too bad either. Thank you very much.
Thank you, Reuven. It's hard to go after you because you are really just dynamic, and there's so much in there. I'm still trying to figure out what he said in the second paragraph. Right. So let me first add my thanks to the organizers, Professor Johnson, for our panel, but the organizers of the event. It really is a spectacular day, and of course, as you know, I'm an outsider among you. I have infiltrated from inside, out, and back in again. But here I am, being asked to give advice to President Obama. Well, I'm delighted to give advice. So I don't think he's going to listen to me, but I'm delighted in any event to have the opportunity. Okay. The first Obama administration oversaw the enactment of 2 reforms that blow apart some ideas that we have about the tax state. And if my conversation this morning in the hall is any indication, some of you may not know one or both of these. You just might not even know about them. So I'm pleased if that's all I do today is just educate you about your own law. That's all right with me. Both of these regimes passed with little fanfare, quietly, added as riders to other bills that were much bigger, much more important, and had a focus that was completely different than these 2 reforms. That has led both bills to be seen as having been stealthy, right? Seeing things happening in the dead of night, not subject to a lot of discussion. And both bills, in fact, had been raised as independent legislation and failed on their own terms in the Congress, and so slipped in afterwards. Yeah. Okay. So you see that both of these regimes that I'm going to talk about, neither one of which I've named yet, acronyms coming, I promise, are already kind of a bit odd, right? Not being subject to a lot of public scrutiny. And what I'm going to tell you is that I think that both of these regimes give us a slow reveal of a picture of what the state, the tax state, is going to look like going forward. Okay? But neither reform is finished. That is to say, both are yet to be implemented. Both are subject to strong opposition, some I think rightful, some maybe not so much. And both have pretty big obstacles to overcome. And I think it's worth looking at them. because they have underlying goals that I think we are all going to agree with. And so it's worth saying to the second Obama administration, let's go. Let's get this done. You started something. Most people may not even know what you started, but we're going to look at what you started, and I think these are big, it raises some big questions. All right. Now, I wrote in my notes here that both regimes are attempts to save the income tax, and in the back of my mind I thought, well, I don't have to explain that. People want to save the income tax. Right. I'm not so sure after today that I can confidently say that. So, but I would say that if we are going to save the income tax, and I'm talking about the personal and the corporate income tax, we have to start asking ourselves some pretty big questions about what states can and cannot do in a world that is globalized, economically integrated, and characterized by technological change, advancement, innovation, which is in the financial sector just as well as anywhere else. And so some of the questions that I'm going to ask are questions that are academic, theoretical, even metaphysical, I think, therefore I am kind of questions. And a lot of these are questions that I don't think have troubled policymakers, like what is the state? What can a state do? What can't a state do? But I'm going to say that normally we just start from the proposition that states exist, they do things, that's uncontroversial, and states can tax, and they do tax. Just look around, and there's the tax state in all its glory. Look at what it does. But what I'm going to suggest is that if we don't find a way to save the income tax, then what we're seeing is that states are devolving into taxing the easy to tax, which is not in any way just. And so both of these regimes can be seen as attempts to pull back that paradigm, that unfolding paradigm. Okay. Now I think if tax practitioners, academics, and students of the law are not thinking about what is the state and what can it do and what can it not do, then they're not paying attention. What are they not paying attention to? Well, a big question that we're asking ourselves is what is going on with the state these days? Have we lost control? We're told that the state is losing control over its people and its resources. Between creative tax planners, dodgy clients, and complicit governments, the state is losing its touch when it comes to taxation, right? And the result, yeah, that's Depardieu in the corner. You know, this guy, Savrin, yeah, okay, you don't have to go too far into that. You see where I'm going. What is the result? Well, it's massive debt and debts and deficits, the dismantling of the welfare state as we know and love it, protest in the streets over international tax, not tax, international tax, which most people didn't even know existed, right, until the latest crisis. And what we have is going on, I think, two recastings. A recasting of the taxpayer in a moral, ethical role. A duty to play nice if you're a corporation, spirit of the law, not letter of the law, stop exploiting loopholes, da-da-da. And at the same time, a recasting of the state in a policing role, that you are all potential criminals, all of you, and we need to watch you. It's not enough to catch you after you did something. We have to preventatively watch you and make sure you don't do it. We have to take away your ability to perpetuate crimes against the state. Okay, and this, it means smoking out delinquents for the benefit of all other members of our society. You see the protesters. Okay. But this recasting is not easy because it comes in opposition to some pretty strong tendencies in the structure of the state as a member of global society. So I want to talk about the state and what I'm going to call its mercenary tendency. States are responsible for economic growth. We've decided. We're not thinking central planning, but we still think that states are responsible for economic growth. This requires competitive regulatory policies. This has led us to an imaginary line between fair and unfair competition among states. If I had a lot more time, I'd talk about what that competition is comprised of and who decides what's fair and what's unfair and how that all plays out. But I don't. But the primary objective here of this theory of the state is that we should cooperate with other states in principle, but defect in practice. I believe Professor Gratz has said that in one of his papers. I usually cite him for that. I cite Dan Shaviro for the same principle. But notably, remember, it only works if we prevent others from doing the same, right? We have to gain an advantage. It's not a level playing field, it's an advantage we see, right? And at the same time, that's put against a different concept of the state, a theory of the state, which is that states must be accountable to their people. That means the tax system has to be at least viewed as fair. We need a patina of fairness. It doesn't actually have to be fair, but just fair enough that we don't have people up in the streets protesting about the unfairness. That's very unsavory. We need tourists at the White House. We don't want a bunch of people protesting there. And what do we get for fair? Well, asking the same of all taxpayers, however we define that word, and it has to be imposed equally on all taxpayers. And the primary objective in a state that looks like this is to catch our shirkers. Okay. We have there, in these two ideas or conceptions of the state, a basic paradox. And I would submit that the two pieces of legislation I'm going to talk to you today are a result of the almost psychotic fighting of ourselves with ourselves as to which of those two states do we want to be. And I'll give you an illustration. Senator Paul Ryan, in 2010, the year that both of my legislative regimes was passed, said, we, meaning America, need to have a tax system that makes America a haven for capital formation. Let's make this country a tax shelter for other countries instead of having other countries be a tax shelter for America. And notice, that's the first part, right? Competition. And this would ultimately raise revenues and promote economic growth. Okay. So there's our example of this internal struggle. What should we do? Enter FATCA and EITI. Who knows what FATCA is? All right. Who knows what EITI is? Not EITC, EITI. Aha, the conversation in the hallway is confirmed. The EITI is the Extractive Industries Transparency Initiative. It was tacked on as a 2-page bill at the end of Dodd-Frank in 2010 after failing to pass on its own merits in 2008 and 2009. What is it? It is corporate, oh no, tax disclosure. She just gave me the 5-minute sign. This is going to be impossible. It is corporate tax disclosure under EITI. Publicly listed companies in the extractive industries sector, oil, gas, minerals, will be revealing to you, the taxpayers, the shareholders, the stakeholders, civil society, all payments they make within the company and to other governments. In other words, they will be revealing their transfer pricing actual outcomes and the actual tax, not book, actual tax payments they make to foreign governments. Okay? The goal, stop American companies either fostering offshore corruption by paying, bribing, whatever, or, and I think the big or here is what you see in the tax protests in the seat, or avoiding too much tax globally. There's some sort of floor we don't want you to go below. And if we can show the people how this tax system actually plays out on the ground in practice, they will be in the streets protesting their legislators saying, why are you letting all this money out of the tax net? Why aren't you stopping this? Okay, that's EITI, Corporate Tax Disclosure. Foreign Account Tax Compliance Act, FATCA. The idea here is that it's to expose Americans who are hiding money offshore. Now, that one's pretty simple, straightforward, right? People who are rich have offshore bank accounts. I'm going to just confess to the IRS right now that I have an offshore bank account. I am not rich, but I am Canadian and I live in Canada, but I have US status and I have to write my checks in Canadian currency. And that means I need a Canadian bank account. But that makes me a suspect, a criminal tax evasion suspect in America. And the goal here is to stop me and people like me hiding, no, not at all, of course, hiding cash offshore, but with the help of foreign banks. Now, you know where this comes from. The impetus is UBS. You've seen it all. You know why this is here. Okay. What role do these two regimes consider for the nation state? Well, we have a conceptual boundary of tax sovereignty that's being stretched. Autonomy, non-intervention, pragmatic allocation practice in cases of overlap, that's what we used to think. And we have this question arising. Are we now, as a tax state, the victim of globalization, technological change, or are we the master of it? And I will tell you, and I wrote this out in my paper, you can read it for the details, that these two regimes suggest that we are the master, not the victim. There are no legal boundaries to the U.S. tax jurisdiction. None. No one can stop you if you want to go as a tax state and find your taxpayers however you define them. That is, I think, a big step, and it's very, very controversial, and I think it's worth thinking about them. But this means, what is the implication of this? The jurisdiction extends to taxpayers wherever they are, and all the institutions, and I wrote financial, but maybe it's too limiting, all institutions in the world that serve them. We have the ability as a tax state and the obligation of a tax state to go after all of these actors, right? And the question of capacity, can we do that, has now been answered in the affirmative, which should raise for you the question, why did it take us so long? Why have we been letting people out of this tax net for so long when we've had this capacity all along? What was stopping us before? I would say that the answer here is that we've now decided we can, not only can we, but we should exercise this dominion. And so here are my two advices. Do I have 1 minute? I see it coming up. EIT, implement it and then expand it. Reasons for pessimism that EIT will go forward. Industry opposition is delaying it and may kill it. Anonymous incorporation thwarts transparency. As long as you have anonymous incorporation, you are not going to have EITI. Read my paper if you're not sure why that is. Reasons to press forward, because stakeholder interests apply equally across the board to all industries. So obviously the answer is, to get a level playing field, you've got to have disclosure for all corporations, public corporations. Why not disclose all intercompany payments and all payments from foreign governments? Then we all know we're on the same page, right? Saving corporate income tax, I think, might be impossible unless we do this under public pressure. That is, if we, the people, don't get exercised about what's going on with international tax and the multinational corporation, then what is going on will be the disappearance of the tax of the multinational corporation. Okay, my advice, let's see what we get from Dodd-Frank. Let's get those rules implemented already. It's taking way too long. Let's go. And then let's expand it to its scope to all U.S. public companies. All right, FATCA, fix it or forget it. You've got some big problems here, big reasons for pessimism. It's a one-way street. It's only designed to catch U.S. tax evaders. The U.S. is extremely attractive to foreign tax evaders. It will not stop offshore. It will not work as long as the U.S. is playing tax haven, which it is. Reciprocity is an aspiration at best in FATCA. She says, please conclude. It's so polite. It's a terrible deal for poor countries who cannot enter into an agreement with the U.S. to get an IGA because they don't have tax treaties. So all those countries from whom tax dollars are siphoned on a daily basis to their huge detriment, all the poor countries of the world are left out of this regime altogether, and we have no answer for them from the U.S. We're not interested in their problems. We're only trying to catch U.S. tax avoiders here. Opposition is arising, and I think rightfully, from an expansive and even intrusive U.S. tax jurisdiction. Reasons to press forward. If the big fish jump out of the net, you might as well forget the income tax. We already saw from, I think, Ed McCaffrey and others, that there's no middle class left to tax anymore. If the big fish are out too, then it's done. We're done. Moving right along to Professor Gratz's proposal. And you get two birds with one stone. Tax evasion links to other crimes, so if you can get this done, you actually could solve a big problem. Here's my advice. You have got to make FATCA really reciprocal. Stop this messing around. If you're going to be anti-tax haven, you can't be hypocritical about it. You've got to stop being a tax haven here too. And this is the big one, you have got to get real on citizenship-based taxation. You have 7 million Americans living abroad who just have checking accounts, and their banks are closing their accounts because they don't want to deal with Americans anymore because the costs of compliance are going to be quite high. You've got to switch to residence-based tax, and here's my appeal. Look, if all the other countries in the world did citizenship-based taxation, what would the tiebreaker be? It would be residence. Let's just get it together. We're the only ones that do citizenship-based taxation. Time to understand that that just does not work in a world of dual citizens, and you are, in fact, restricting Americans from going abroad. How is that in the U.S. interest? I don't see it. There are some relatively easy fixes. Two lines. Here it is. Same country exception. High tax kick out. Thank you very much.
Okay, lots of interesting ideas to be presented today. So without further ado, I'm going to turn it over to Professor Morris.
Thank you very much. Thanks to everyone here. It's so great to be a part of this fantastic event. And there have been a lot of big ideas today, which I have really enjoyed listening to. I am going to send off the last of the papers here with a more modest idea, but it has an advantage, which is feasibility without congressional involvement. So it's worth listening to, I think. It is about transfer pricing. But before you decide to nap, let me try to add some context. We know from the earlier portions of the day that our fiscal needs indicate that tax rates are going to go up. I don't know whether that's going to reduce work effort or not. And in fact, in the corporate context, I'm not sure that higher U.S. tax rates will really have the effect of driving actual economic investment as opposed to tax profits outside the U.S. But high tax will definitely increase planning. And my paper is basically about tax planning enabled by complex implementing guidance. And the opportunity that tax administrators have to reduce tax planning's options through smart regulation. Now, the transfer pricing regs, which try to protect the U.S. corporate tax base by policing intercompany pricing, and I don't think I know anyone who thinks they do a very good job of that, but that's what they're trying to do. They provide my case study. But the point translates. There are tax regs out there that say, no, no way, nice try, forget about it. One example is the 382 net operating loss regs with a little asterisk for the recent Solyndra bankruptcy kerfluffle. Another example is the passive activity loss regs, I suppose, with an asterisk for real estate. But the transfer pricing regs, like the 704B regs that Karen Burke mentioned earlier, basically say, maybe, if you say so, what do you think? And I guess we can work with that. In other words, they give taxpayers way too much wiggle room. We should change this. And in partial response to Steve Banks' presentation earlier, I think we should be prepared to do so unilaterally, although acting within the shadow, I suppose, of the realization that there are multinational discussions going on about related issues. So transfer pricing is one of many factors that make it possible for global multinationals to have a very low, probably 3 to 6% current tax rate on their non-US income, and also to use their non-US subsidiaries to erode the US tax base. Transfer pricing is a big regulatory target because there's a lot of discretion provided in the rules, which simply say that the commissioner has discretion to allocate so as to clearly reflect income among related parties. Yet the existing regs are so complicated that they give taxpayers a lot of planning options, and IRS enforcement efforts just can't keep up. So I think the planning options should be constrained, and there are a number of ideas out there that would essentially do so by incorporating additional formulary ideas into the transfer pricing rules. So this is not the idea that Reuven proposed of a global, what I call his idea, a global destination sales-based formulary apportionment. So I'm not sure that's the leading moniker, but that's how I think about it. But these are incremental ideas that would change certain elements of the transfer pricing regs to restrict taxpayer options. So here's one example. Stephen Bank talked about the Google offshore structure. One linchpin of that structure is the fact that you can transfer IP offshore as a U.S. company to a non-U.S. sub, and you sell it. The U.S. parent sells it to the U.S. non-U.S. sub, and it does it through a buy-in, and the key there is valuation. Well, sort of, but the fact is that the U.S. regs permit the U.S. company to value the property that it ships offshore to the non-U.S. sub, and valuation is a taxpayer's game. It's very difficult for the government to challenge that. So one point I'm trying to make in the paper is, hey, the government gave that away. They wrote the regs that said you could do the buy-in. So why don't they just rewrite the regs? And then you can't do the buy-in anymore. Wouldn't that be helpful? What would they do instead? Well, my friend Alain Ben Shalom has the idea of tying IP ownership to the location of employees that produce IP through R&D efforts. Maybe that's one idea that I can work with here to try to illustrate this concept. So Alain's idea takes advantage of a strong business friction, which is employee location. This is similar to Marty's idea that ties interest deductions to gross profit. He's also there trying to take advantage of a strong business friction. It reduces taxpayer planning flexibility. It's protected by a deferential standard of review confirmed by Mayo. The Mayo case, this is the Chevron standard of review. It doesn't present litigation risks. It's more lasting, although prospective, compared to, say, notice guidance or private guidance. There are risks and downsides. One is that using a business friction as a guidepost can be a double-edged sword. Now, what if we tie a transfer pricing standard to employee location and then employee's location is changed? Maybe it's moved, for example, out of the US in response to a transfer pricing rule that ties the allocation of corporate profit to the employee location in the first place. That's one possibility. I'll talk about that more in a minute. Another possibility is that even though there is a very deferential standard applied to regulations under the usual US rules, there is a possible treaty issue, and the NatWest case, which Reuben kindly reminded me of when we had an exchange prior to this, to today, is the leading example of this. What if treaty partners object? That doesn't meet the arm's length standard. Here I am saying, and I agree with Reuben on this point, that there should be room under the arm's length standard to define it in a way that doesn't give away the store. But maybe other countries don't agree with the way that Alain, for example, would allocate intellectual property ownership. Would they object? Would there be NatWest-like litigation that didn't reflect the treaty partners' meeting of the minds when they executed whatever relevant treaty there was? So to these objections, I would say, first to the double-edged sword. It's kind of a matter of almost religion, I feel like, whether you believe that if you, say, allocate according to employees or allocate, as Reuben would, according to sales, whether that would affect taxpayer behavior. I'm not sure I read the available empirical literature to suggest that it definitely would. And I guess that I feel comfortable with this level of incremental proposal, partly because it seems like a lower risk strategy to me than overall global formulary apportionment. It would be a component of the way that we allocate profit, for example. It would likely be less salient and have more of an impact, therefore be lower risk. And also, as you can read between the lines of what I'm saying, my religion is not necessarily that putting a big emphasis on, for example, payroll-based allocation definitely would result in actual employees moving places. I'm not sure that that's clear that would happen. Second, on the treaty litigation point, here's the thing. First of all, you could take steps to mitigate litigation risks. You can talk to treaty partners, for example. You can figure out what their position is. You can try to get them on your side. And it may be that some of the clearer rules that would give taxpayers fewer options would actually allocate income away from tax havens, but not necessarily allocate income away from treaty partners. So it's possible it would fall out. They don't have much to object to. But even if they did, here's the thing. The job of Treasury and the IRS in, for example, the promulgation of transfer pricing regulations is to provide the first line of defense against tax-based erosion. So I'm really just trying to ask them to do their job. I would like them to use this primary tool of regulation to say no more often. Thank you.
I would now like to turn it over to Robert Goulder, who's here. Robert Goulder is the editor-in-chief of Tax Analyst, a prominent online news service. He is also a frequent author of the Tax Analyst blog and has authored more than 200 technical articles dealing with international taxation. It's a great honor to have you today, and I'll turn over to you now for your commentary.
Thank you. Well, I think we've saved the best for last, at least in my opinion. With all due respect to the other panels, this is some interesting stuff here. I think international is really where the action is, where the money is, because that's where the worst problems of the current system seem to be. Looking at the three papers, taking them in order, starting with Reuben, your comment that what President Obama has proposed with respect to corporate tax reform, that it isn't so different from what Chairman Camp has proposed, is really a point. I think that's absolutely true. And I don't know if that means we should look at what, if there's not that big a difference between them, who's wrong, who's off, what's wrong with that picture? Did Chairman Camp, not really show his fervent conservative vigor when he released that? Why was he being so reasonable or practical? And when President Obama, the so-called socialist, said, "Oh, let's cut the corporate tax rate from 35% to 28%," a lot of people said, "Well, no, that can't be right." He wouldn't go around talking about cutting rates for corporations. So that's worth everyone acknowledging. And you hear so much talk about wild, crazy, ambitious tax reform plans. If this is what we're coming up with, it kind of looks like sort of mild stuff. So I kind of wish we had more radicalism in the corporate tax debate, although we will get to radicalism when we get to Allison's paper. There seems to be an implicit assumption that we're assuming territoriality is the way to go. And I'm yet to be sold on that. When you look at the current tax system, you think, isolate the problem. What's wrong with it? Well, there's lots of problems. We have a very high rate, and that creates some unfortunate incentives. Everybody wants to shift income to other countries, and they want to take items that are deductible or losses and shift them here. Okay, and those incentives are a function of the high rate. So I understand the case for wanting to lower the rate. The lockout effect, the way we have a worldwide regime is we're taxing domestic profits. Currently, foreign profits, we tax them when you bring them back, when you repatriate them. If you don't bring them back, you let them just sit parked in the Cayman Islands or someplace, you don't pay U.S. tax. You might pay tax in that jurisdiction where they're parked, but that might be a tax haven and they don't have any taxes there. So hence the saying you hear from practitioners that a tax deferred is a tax avoided. And I'm not sure that either the Obama plan or the Camp plan would really get at that totally. I mean, I was always sort of sympathetic to the idea of what if we keep instead of going territorial, to go in the other direction, do something like you would with the Wyden-Gregg legislation from a few years back, where you kept a worldwide system, you eliminated deferral, and there's the poison. The sweetener is that you would lower the rate perhaps very much, even lower than the Camp rate. Personally, I am ambivalent as to what the rate is. People always want to talk about what is the rate. I really don't care. It could be 15%. We could do in Ireland and go to 12.5%. I think the intelligent debate is not about what the rate is. If you have tax reform that gets rid of holding companies in the Cayman Islands, you've done something good. And by that I mean sort of bogus shell companies in the Cayman Islands. If you actually want to move a factory there and make widgets and sell them everywhere, that's fine. So tax advice for the Obama administration. I was almost hoping, Reuben, that we'd hear something from you along the lines of Wyden-Gregg or let's get rid of deferral. But of the things that you did mention and isolate in your paper, they all make a tremendous amount of sense. The managed and control test, we absolutely need that. It bothers me somehow that you could have a hedge fund in Greenwich, Connecticut, and every single person associated with that hedge fund, everyone who has any connection with it is in Greenwich, Connecticut, yet it's not a U.S. resident because of a scrap of paper in an attorney's office in Bermuda. That's just bogus. What are the philosophical pillars on which we build this corporate tax? It's source of income and residence of the taxpayer. But what is corporate residence in this day and age? It seems that corporate residence is wherever you want it to be for tax planning purposes. And that cannot be sustained in the long run. And the most immediate, direct way to do something about that is the managed and controlled test. And it needs to be managed and controlled, not managed or controlled, because if you take care of management, people will play games with the control. That's how good these people are in the tax bar. Hold on. The inadequacies of 78, 74, yes, thank you for pointing that out. You were not jumping on the bus late. You talked about that when the legislation came out in 2004. It was true then, and it's true now. Let's see. The other items that you talked about, how much time do I have? 10 minutes? Excellent. I can keep going. I'll ignore the FERPTA stuff because that didn't excite me. Oh, yes. Foreign tax credits. And I was very surprised to see the recommendation about putting them all in one basket. You seem to think that the basis for having multiple FTC baskets would be that you're going to have corporations in excess credit positions, and you probably shouldn't have corporations in those positions given the fact that the U.S. rate is so high. But I scratch my head, and I'm just a little bit reluctant to go down that route of put them all active and passive in one basket, because it seems that the tax bar is really good at just waving their magic wand and conjuring up excess tax credits from nowhere. Look at the Guardian Industries case. So as long as we're going to have situations like that, I'm a little bit leery about getting rid of the baskets, but that might just be me. Transfer pricing, well, again, if we do White and Gregg and we eliminate deferral and tax on an accrual basis, maybe the transfer pricing case goes away. Certainly, if you lower the rate down to something like 15%, which I know sounds crazy, you're probably what was in the Kool-Aid. But again, the point is, don't get fixated on the rate that we're taxing corporate income at. Worry about whether you have deferral, whether you have the lockout effect, whether you can get rid of the things that are actual harm in the system. If we're stuck with the arm's length method, then yeah, I like the idea. I actually gave it a name here, the ACD plan. The A is for Aviona, the C is for Clausing, and the D is for Durst, who also writes for tax analysts, shameless plug. But no, there's a plan that came out in 2009, and I think that's the right way to go if we're going to be stuck with transfer pricing. Okay, that's it, Rudy. Thank you. Allison, goodness. Okay, we all know FATCA now, and we all know EITI. All the law students in the overflow rooms, if any of you decide to become tax attorneys, FATCA, that's your future. That's what you're going to be doing. I had a telephone call Tuesday night with a major tax practitioner in Washington, D.C. Didn't want his name mentioned, but he said that of all the new client work that has come into their office in about the last 6 months, 80% of it has been FATCA issues. That's saying something. That is what clients care about. It's big, it's scary, it's onerous. It's the United States telling foreign financial institutions what they can and cannot do. And that sounds, you know, it's what Lee Shepard said, it was like a drone. You know, to send the drones in and just drop the bombs and blow up Bradley Birkenfeld and UBS, and then we won't have people dodging their taxes in Switzerland. But I like FATCA. I want to defend FATCA because, to me, it's a transparency issue. If you seek to tax a thing, people shouldn't be able to conceal that thing. You know, if society decided they were going to tax golden retrievers, you know, you can't go around concealing your golden retrievers. Whatever it is that you're taxing has to be out there and visible and subject to the tax. And it really is amazing that this hasn't been done sooner. You know, think about it. I live in Arlington, Virginia. If I go down the street in my go down the street near my house and I set up a bank account and I get interest income, how does the IRS know about it? Well, through reporting. Yeah, but if I can somehow get the, you know, hire Bradley Birkenfeld and have the money be in a bank vault in Switzerland, all of a sudden the income from that account, you know, the IRS can't see it. And yes, according to the rule of law, I have to report it on my tax returns. Well, guess what? You have tax enforcement on the honor system. And you never really want to have tax enforcement on the honor system because you're just not going to get good results. And that is where I think FATCA rings true. We're the only country doing it now. I'm not sure it's always going to be like that. If you look at what's happening internationally, there was a very important election recently in the Bundestag in Germany, where they were talking about a agreement with Switzerland, where they were going to basically let German citizens have secret bank accounts in Switzerland. And as long as a withholding tax was collected at the source, the German residents didn't have to include that income on their tax returns. And it eventually got shot down and dismissed, even though the German finance minister was a major proponent of it. What that would have done, it would have transformed a place like Switzerland from a tax haven to a privacy haven, which tells you something about their business model and what was really important to them. They actually don't care so much about people cheating on their taxes. People want to conceal the wealth. That's what it's really about for them. So the Swiss were volunteering, basically, to collect the tax as long as they could keep the names of the account holders concealed. That didn't pass. So Germany's not going to do it yet. All of Europe's in austerity. People need the money. This is a tax gap issue. You know, nobody wants their taxes raised, yet the government needs more revenue. Isn't the most logical thing to try to collect taxes that are already due and owing under current law? Really, FATCA is a tax gap issue. And every other country, I assure you, has an interest in doing that. They are all watching FATCA. If we have the same conference 10 years from now, in 2023, there's going to be a panel about how you harmonize, you know, the 20 FATCA, thank you, how we harmonize the 20 FATCA regimes that are in place. Because I guarantee you, the UK is going to have one because Brits all stash their money in the Isle of Man. The Japanese are going to have it because people stash their money in Singapore. The Italians are going to have one because people stash their money in San Marino. So on, so on. You're going to see a lot of this. There needs to be a multinational framework for harmonizing these things, because I assure you, the big banks of the world, they don't want to have to comply with 20 or 30 different FATCAs. They only want to comply with one. So maybe the United States, by being big, by being bold, you know, maybe we've set the example. And if we can get it right, then other countries can just emulate us. So I feel bad for you if you know, the IRS gives you a hard time, or if your bank decides to cancel your account, because that's what's happening. We're seeing more and more foreign banks are just saying, we don't want to take business from Americans. What does that say about the world when you know, what kind of a business doesn't want to serve you? It would be like going into a Starbucks and they say, well, sorry, we're not going to give you that, you know, hazelnut latte. That's their business. That's what they're supposed to do. They want these accounts, and they're actually turning them down because the compliance burdens of FATCA are so scary. EITI, yes. From your lips to God's ears. Let's do it. Country by country reporting is what it's all about. If stateless income, thank you. If stateless income is a problem, you know, doesn't it figure that maybe taxes really aren't being paid anywhere if no country can claim jurisdiction over the income to tax it by source or by residence? It's just for the extractive industries, expanded to everything. It's transparency. Where you don't have transparency, you will have corruption. The two go hand in hand. It's a marriage of convenience, really. And I was told I need to conclude. So, Susie, I conclude with you, and I apologize if I've given you, if I haven't budgeted my time here, but transfer pricing is really the big problem. What do they say about World War II fighter pilots that were getting shot at? If you're getting flack, you know you're over the target. You know, you're getting flack because transfer pricing is right over the target. It's a non-system. It's unenforceable. The IRS is not equipped to deal with this, and the courts are not going to help them. You look at the case law, you look at NatWest, you look at Xilinx, you look at Veritas. All of those cases send the message that the system really can't cope with the transfer pricing abuse that's going on. And there's another case that just came out. In fact, tax analysts broke the story earlier this week about the Amazon case. It's a $1 billion transfer pricing case that's being litigated. So to the attorneys in the overflow room, transfer pricing and FATCA, that's your future. Thank you.
Thank you for your insightful commentary as well. We're now going to open the floor to questions. from the audience, both online and here today. If you have completed a note card with a question, please feel free to pass it down to the front to one of our law review members. Otherwise, if you'll just raise your hand if you have a question. Yes, you, sir, in the back.
Sure. Okay. So just to answer the first one, it looks reciprocal until you read it. So it seems reciprocal. It calls a reciprocal agreement, but if you actually read the IGA, you'll see that it's not reciprocal. It's only reciprocal in aspiration. And if both, all of them. Just you have to read it. You have to read the fine print. And look at 6049 and the updated regs, and you'll see what I mean. And I detail it in my paper, which is in your packet today. So happy to talk to you more about that later. Why don't Canadians want to file their tax? I don't know. I mean, I'm obviously not, I'm not a well. Here's I think the bottom line. What you have is kind of a funny thing. You're a U.S. citizen if one of your two parents was a U.S. citizen, even if you were not born in the U.S. And you're a U.S. citizen if you were born in the U.S. but you didn't grow up here, and so it's not. It's actually not people who are coming of age now that should be upset. They know what's going on. It's people who have been in Canada for 50 years, have never filed a tax return in the U.S. because they didn't know. I mean, I always think, of course you know, right? But most people really just don't know, and so they find out, and then the penalties are quite onerous, and some of the stories are quite onerous. Including a woman whose disabled son has U.S. citizenship and he can't. It's like personal stories. And if you go online and you read, you'll find a lot of this. I'll tell you what I think. The Canadians who talk to me about it are afraid. They're scared. And I say, you're a small fish, a minnow. It's not. But they're afraid because they have been told it's a $10,000 penalty for non-willful failure to file. That is, if you're ignorant, you didn't know, it's $10,000 for every year you didn't file. And that creates fear. And then the other, I think, piece of that is that a lot of things that you would not think of as problematic are, for example, if you have a pension fund in Canada, it might not be a pension fund in the US, it might be an offshore trust. And now you have an offshore bank account and an offshore trust, and a lot of that stuff is going to be taxed on a current basis. It's not deferred. In the US, it's not deferred. So you have a savings account in Canada, a new tax-free savings account, which I can't have. Well, at least I can't have tax-free because I have to pay the tax now. Is that a big deal to me? No, I'm kind of a tax geek. I like it's kind of fun for me. But I think it's very intimidating, and it is a huge compliance issue, and it is most especially a compliance issue for people who didn't know until 2010, which is when FBAR became an IRS issue. Before that, they weren't enforcing the FBAR, right? They weren't enforcing it, not at least regularly. And so you have 1 million or so, maybe 2 million in Canada. You have about a 7 million population of American citizens living in other countries who now many of them are facing, just big compliance and fear, a lot of penalties and a lot of pain. And for what? Because they don't think they're tax evaders, right? They're in Canada. High tax, which is why I said high tax kickout, but that's for another day.
Thank you very much. We have one question here and also one in the back, so I'll start here and then you next. Yes.
Well, maybe I will. I think that would be a big education for me. Well, that's very nice. I hope that would prove to be true as well. I guess since this is a kind of a call to arms for the Obama administration. Hey, you do have the power to do this, but you really have to stand up and do it. I think I do underestimate the challenges that lie before these folks, and some of them are in a revolving door position, perhaps, and that makes things more challenging. Interesting. So I'm really addressing myself to the career civil servants who happen to serve in the Obama administration. Perhaps. Okay. Good to know. The story I've heard is the Notice 98.5 and 98.11 story, and the fact that those, especially 98.11, got revoked quite quickly. And I think that if I can speculate, probably affects the way that people think about aggressive guidance in the Treasury and the IRS. And part of the point of this is to try to encourage them to...
And the person who wrote it was blackballed by industry when he left Treasury. That's really the issue.
Thank you, Marty.
Thank you. Did you still have your question in the back? Okay. That's a great point as well. We have time for approximately one more question, and there's a question on my left. So we'll take yours as the final one.
No, not comfortable at all.
Well, so, let me say a couple of words. I mean, of course, the part of the impetus behind the question is the horrible experience with the 2004-2005 amnesty, where we got 300 billion back, yes, but none of them were invested in creating jobs, which was supposed to be the impetus, and there have been several studies of that. I mean, companies brought money back at the same time that they were actually firing people. And James Gravel documented that very nicely. But having said that, I think the devil is really in the details. I mean, the reason, first of all, let me say something about White and Gregg. I testified in Congress in favor of White and Gregg. I'm all in favor of that. The chances are zero. I mean, we've been trying to enact the end of deferral since 1961.
Think big, though. You got to dream.
Yeah, but we're trying to give practical advice to the Obama administration. What are the chances? Even they are not supposing that the only people in the world, the only people in the world who do it is Brazil, and boy, are they complaining about a CFC regime which has no deferral in it. I just don't think in today's world that's realistic. What I'm trying to do is align the U.S. system with what most other countries do, which is to have this kind of limited territoriality, i.e., exemption for active dividends, but to have quite strict CFC rules. And this is, I think, the key point to Jim's question. Much to my surprise, the anti-profit shifting provisions in the CAM proposal, I think with some adjustments, are quite tight, and they are very similar to what the UK, the Japanese, the Europeans do. And the one thing that is clear is that all of these countries that have territoriality have not been suffering from nearly as much income shifting as we do. Just look at their corporate revenues and look at their effective tax rates. I mean, they have the exemption system, and yet they collect quite a lot because they have this, triggering of the CFC rules by a low tax rate in the host jurisdiction, which is, I think, the key provision. And so I think if we do that, at least in the immediate run, but in the long run, I think the right answer is formulary, and that's why, even to Bob's point, we're not going to resolve transfer pricing by moving to the abolition of deferral, because they're still inbound. And inbound is important, and people kind of neglect that, in my opinion.
Thank you very much, Professor Avellana, and also Robert Goulder for those closing comments. Let's thank all four of our panelists for providing international food for thought and some thought-provoking proposals. Thank you again.
All right.
Thank you, everybody. At this time, we're going to reintroduce David K. Johnson to the stage to offer some concluding remarks on what we have learned today at the symposium.
Well, I assure you, you'll be out of here in a lot less than 30 minutes from now, which is what they put on the agenda. I think there are some very significant things that we've heard today if you step back and think about the broader schemes. One of the consistent things we've heard is that in this era of globalization and new accounting rules, both the corporate and the individual income tax system are under assault. That, like that cartoon the New Yorker ran years ago that showed one brontosaurus talking to the other and saying, warm weather, lots of food, we can go on like this forever. Things can change suddenly. And while this is momentarily, a month from now, the 100th anniversary of the amendment that gave us the individual income tax we have, I think it's significant that Michael Great started out by pointing out that a lot of people look upon the idea of fair distribution as he put it, quaint. In fact, it is central to these things. It is central to the birth of democracy and the development of the moral basis of progressive taxation. Michael also pointed out to us, however, that we would be a lot better off if instead of listening to lawyers, we listened more, as Congress did in 1913, to the economists about how to design a system. And whether having something closer to 1913, which really means we tax what back then were called surplus incomes through an income tax, and we had consumption taxes for regular services people get, we might find we would have a much better system. We also had a panel that had nice balance to it. We had Dorothy Brown on critical race theory, we had Francine Littman talk about the poor, and we had Dean Stark talk about the middle class. And all of them showed in what they were doing the same basic point, which is that we are devising rules and reinforcing rules and adding to rules, the net effect of which is overall to shift burdens downward, relieve burdens at the top, and to not raise sufficient revenue to provide the underlying services that are needed by government. And Dorothy argued that because we have these large middle-class tax exemptions that only a minority of people benefit from, significantly less than half of all homeowners get the mortgage interest deduction, real reform is possible. Only 29% of taxpayers get the mortgage interest deduction. I think she's right. Real reform is possible. And Francine suggested that rather than talking about cutting programs that help the poor, we should be talking about how do we strengthen these programs so that we have less poverty. And the numbers that she showed on child poverty, especially those of you who are students listening to this, you should take a look at those and you should think about the world you're going to live in the future. When you're my age, the world you're going to live in if we don't address this issue of child poverty. And David Miller, one of the commenters, brought up the issue that recurred a number of times in this panel today, that we've got to figure out how we deal with wealth. Because with wealth, you can avoid income taxes. With wealth, we distort the numbers. And a lot of this, I would argue, is data collection that we need to figure out how to properly do. And Bruce Bartlett added that point, saying wealth has to be brought into the discussion. Now, wealth, of course, takes us to the gift and the state tax. And we now have this very substantial $5 million per person, $10 million nominal amount you can pass on. As everybody in gift and estate knows, that means it's enormously more than that. I guess the Romneys would be the poster children for that. They put $1.2 million or less into a fund for their 5 sons that had $100 million in it, and I'm absolutely certain that every step of the way it was perfectly legal. Ed McCaffrey reminded us that the best strategy is, of course, this assumes you have enough money to feed yourself and have a surplus income, buy assets that appreciate, borrow against them, and die. Buy, borrow, die. It's exactly correct, and that is, in fact, what we're going to see more and more of, and that in and of itself presents to us some serious questions about the future of the system. One of the most unusual insights today was from Grayson McCutch from San Diego, who pointed out that maybe, just maybe, the way that most of us think about the dynasty trusts and the perpetual trusts is wrong. That the moving factors on that were not what we think they are, and that, in my language, the way to think about it is, gee, maybe this is basically a scam run on the gullible rich to tie up their assets and collect big fees and create potential traps. I was especially astonished because I had never heard this, that there in fact were ways to create dynasty trusts before Jonathan Blattmacher came along with his brother and the expansion of these ideas. And Jim Rapetti reminded us that we need to think about how taxes affect behavior. The one thing he didn't say, he raised the question of, does the estate tax cause you to save or not save as much? And the only thing he didn't say was, there is an argument that the estate tax causes at least some people with a target to leave to their heirs, to save more because they have to save what they want to leave plus whatever the tax obligation that they have is. Although at $5 million per person, it strikes me unless you really want to leave your kids a lot of money, that's not an issue. Now, we then went into these two panels on international. And what comes out of that is a recognition that problems there are really not largely the way the public has been hearing about them and that members of Congress have been discussing them. The two panels we had of very erudite arguments were not really in accord with anything you would hear if you went to a congressional hearing in Washington. Steve Bank, who has been working on this stuff for years, raised a simple, elegant question. Is it competition between countries over corporate tax rates? Or is it competition between corporations and governments? And I would add to that the idea that corporations began, the proto-corporations of the Romans and the corporations of the British, in service to the state. Are we now in an era where the state exists to serve the corporations? Karen Burke brought up what she called the elephant in the room. And I think she's quite right. It is pass-through entities. It is this idea of a single tax entity and how this turns out to change all the rules. And it raises a question she didn't raise that I think has to be part of that debate. And that is, if we're going to have pass-through entities, is there a way to have traditional C corporations? Can we make them into some kind of a pass-through entity? And if so, how do we deal with the economic gains from those entities in an era of high-speed trading and other things? Do we have specific dates? Do we say, we don't care how long you own it, whoever gets the dividend and the capital gain, we tax you on it? Should we be rethinking as part of how the pass-through entities are affecting operations, partnerships, S-corps and whatnot? Should we be rethinking the notion along in the law of how C corporations are operated? Marty Sullivan, the chief economist at Tax Notes, also suggests two things which I think are not likely to happen. Tougher rules on subpart S. I think the suggestion of tougher rules on tax in Washington is about as popular as a skunk at a Christmas party. And thinking differently about taxing interest. And pointed out that he thinks that the claims on double taxation are overblown, and I think that's absolutely true, but they make for nice, quick political fodder. Oh, I am going to be way short. Good. And then in the last panel that we had, Ruben Aviona, who has, if Ruben got paid for the number of clicks people download his work, he could take us all to dinner. He suggests some things I was kind of surprised by. One was that perhaps Dave Camp and Barack Obama are not that far apart. And that we should be thinking about things like, how is it that other countries who have systems that are being resisted in this country are actually generating more revenue? How do we do that? Because if we don't keep the corporate income tax, what happens? If we don't keep an effective corporate income tax. And I also liked his idea, very simply, that one way to deal with offshore interests is really moving your corporate headquarters. Halliburton did that, as opposed to having a mailbox. But his more important insight was that that's not a stable solution. And that brings me to the point that a number of people brought up. We really do have to think about, well, how do you get some kind of economic cooperation? We are not without tools. We are not without the ability to influence these things. But going to the idea Ruben has promoted for as long as I've known him, formulary apportionment, or what I call single company accounting, is something we need to do a lot more debating on. That idea, single company accounting. Now, Allison, who's somebody suggested was a little radical, and certainly among the groups had the most radical proposals here, said, if we do, and this is, I call the quote of the day, if we don't find a way to save the income tax, then the states are devolving into taxing what is easy to tax, and that's not fair. And that's what the states are doing. They're clearly, especially the U.S., we are devolving into taxing wages that are easily measured and not other kinds of compensation for services. And finally, those of you listening in the other rooms who are young, there's absolutely no question that THATCA is a great place to get billable hours in the future. We're going to see other countries, as the speaker suggested, do exactly what we're doing in one way or another because we're growing more and more into a world that is interconnected. You know, you can go to a ATM in Budapest or Chengdu, China, and put in your PIN and get money out of it. And, well, human beings can't move easily across borders. Money, and especially intellectual property, can. So certainly other countries, real countries, countries that have factories and offices and schools and produce economic activity other than helping people evade taxes, they are going to, over time, grow in the direction of what we're seeing. So I hope people today take away that there were new and different ideas to think about, that you have lots of time to work on these, because President Obama's made it pretty clear that in tax reform, he got what he said he was going to get. Tax increases on people above, he said 200, 250, he got 400, 450, political compromise. But he's made it reasonably clear that that's the end of fundamental tax reform for him. Tweaking, yes, but not fundamental tax reform, and Mitch McConnell has said the same thing. We're not talking about that anymore. So you have lots of time to do scholarship, lots of time to learn about these new issues, and go have a wonderful evening.